Hello and welcome back to the course. In this video, I'm taking a look at a secondary indicator called the CCI. It's the Commodity Channel Index. Came out in 1980, and it's called the Commodity Channel Index, but don't be fooled. It can be used for pretty much anything that gets charted. That being the case, it's very versatile, and this is a very, very versatile indicator. It's a bit much to take in one shot, so you may want to review this video, but it can be used in three different ways. It can be used in divergence, which was mentioned in our divergence video. All oscillators can that measure momentum, and the CCI is no different than the RSI or the MACD. Looking at the chart, you can see that we have 100 and negative 100 with the zero line right in the middle. And the 100 level is a condition that is, depending on how you use it, is either overbought or it's very bullish. It's a bit of a filter. Below 100, negative 100, it's either oversold or very bearish. Now, if you give me a minute, I'll try to explain this as clearly as possible, because this is something that I think gets a lot of people into trouble. So at this point, you can see that we are clearly in a very bullish move. We have broken above 100 and extended quite a bit. And you can see that it showed that we were getting ready to get a very extended move. And this is on the weekly chart of the dollar yen. This was a basically 2,000 pip move. By most people's measure, that's a good year. But at the same time, once we got to this overbought and the momentum started to drift lower, look what the market did. It drifted all the way into a very negative sign. It's a very bearish signal. But at this point, since we have clearly rallied a bit, it's interpreted more as oversold as opposed to bearish, because at this point, the trend certainly has shifted to the upside. And that's the difficulty of using this indicator. A lot of new traders look at it as overbought or oversold, and that's it. And there is more to it than that. It's very versatile, but it has to be used with context of what's going on. So to recap, we had a very bullish candle here. Simultaneously, the CCI was entering a very strong phase, showing real strength, and we moved pretty significantly. Once we crossed back below the bullish area, which would be roughly here, you can see that we did drift lower. We eventually crossed into what would be a very bearish area right here, but in an uptrend. So that means oversold. And in this sense, you need to pay attention to the overall trend. That's not bearish. That's we've gone too far, and we have rallied a bit since then. We've also seen a pullback to the overbought condition, and we've drifted to the oversold condition where we found buyers again. So you have to be very conscious of what kind of trend you're in. I will go ahead and open up another chart, say the dollar Swiss, and I will insert the CCI and see what I can find here, because this is a great indicator, but you need to be aware of the difference between overbought and oversold. Now, in this situation, you can see that we got in the oversold condition. We certainly were oversold there, and that was an extraordinarily volatile event. That was after the Swiss had gotten involved, the central bank. But we'd gotten oversold. We clearly had rallied significantly since then. We got in the overbought condition, pulled back, didn't quite make it. But you could see the problem with this chart, quite frankly, is that it doesn't have the help of a clearly defined trend, because since that significant move, we've essentially gone sideways. I mean, it's a large range, and you have to look at this as a range-bound market. So then these more or less become overbought and oversold indicators. And then finally, I'll open up another chart with a currency pair that has a little bit more of a trend, if you will, and see what we can find there. Okay, here's the dollar, Canadian dollar. And I will put the CCI in this. Okay. Now, clearly, we're in an uptrend at this point. We are drifting higher and higher. So when you get an overbought condition, at that point, it should represent to you that there's plenty of buying pressure. We've been drifting higher for a while. We pulled back here. This oversold condition is in the context of the market going higher. So that signifies that we probably are going to rally. And you can see that we did rally rather significantly. What I find interesting is how oversold we got after breaking down, which had you taken this initial signal, you're nowhere near where you entered. This oversold condition in an uptrend signifies that we should rally a bit. And you can see that we peaked out about here on the indicator. Really didn't do much. Just touched the oversold condition and then rallied again to what would have been an overbought condition. Now, granted, you would recognize that we had gotten a bit extended, so you could see that there is strength as the market continued to go higher, but just eyeballing the market, you can see that we are a little overbought. We got oversold right in this area, took a couple bounces here, and then we rallied again. And now, as we find ourselves in a market that could be possibly changing attitude, then you have to look at it more from maybe a range-bound standpoint there, the overbought and oversold condition, as opposed to bullish and bearish, because it's more sideways. And now we have made a serious breakdown. The question is, are we going to see the momentum pick up to the downside, and are we changing to a downtrend? Well, one of the easiest ways you can do and look into that is a simple trend line. So using this trend line, you can see that perhaps we are breaking down. And when we get to these areas, it's telling us that those will now be signs of momentum picking up to the downside, not necessarily oversold. And that rallies at this point could be overbought, opportunities to start shorting again. Only time will tell. And that's part of the confusion of this indicator, because it can work both ways. It's one that I think a lot of newer traders have trouble with, but in the context of a trend, it makes quite a bit of sense. As far as like back and forth overbought and oversold conditions and sideways action, I tend to prefer other indicators for that. But I am giving you both ways to play it. I prefer to play it with a trend, with a clearly defined trend. And the stronger it gets, the more likely I am to be comfortable buying. And the more negative it gets, if we're in a downtrend, the more comfortable I am selling. It can give you opportunities to add to a position. So like with this move here, once we oversold, you could add to your position there. And for me, that's a much easier way and a safer way to play the CCI.